Hello grade 10s, we are looking at transactions that are entered in the general journal. The first one is bad debts, then we've got withdrawals of merchandise or anything else by the owner, which is drawings, interest on overdue accounts when the debtor doesn't pay, then secondly or fourthly when there's cancellation of discounts on checks that has been paid by debtors, and then there's a cancellation afterwards, correction of errors, and then lastly the adjustment and the transfer journal entries that we're going to discuss in a later module. Okay, firstly bad debts. Okay, so bad debts is a big risk for business. Okay, the problem is you think someone will pay you and then in the end they don't pay you. So if the debtor is not going to pay and they confirm that they're not going to pay, then it's better to take it out of the books. If you can't, all your attempts to recover the money fails. Okay, because the reason for that is a prudence concept. We don't want to overstate any assets at a higher value than in the books than it really is. Otherwise, people will make wrong decisions according to that. Okay. So sometimes people can pay later, and then there's another transaction that we'll do that we'll discuss a bit later as well. Okay, alright, so in this case a debtor has been declared insolvent, his liabilities is more than his assets, and only a portion of his debts will be recovered. In this case, the amount recovered is recorded in the CRJ and the balance is written off by means of a journal entry. So let's look at the example. Okay, Jack, who owes 1,000 rand, has been declared insolvent. Okay, so he can't pay. His estate paid out a dividend of 25 cents in the rand. The balance must be written off. That means 75 cents in the rand must be written off. Okay, so we're on page 169 now. Alright, so 250 will be recorded in the CRJ. This is the amount received from the estate. So it's 1,000 rand times 0.25 or 25 cents in the rand. 750 then will be recorded in the general journal. That's what's written off. This is the amount not received and is written off as a bad debt. Okay, so bad debt is an expense to the trade. You're losing money, so it's expense to you. As a loss incurred, therefore the account must be debited. So expenses are normally debited because it makes the owner's equity less. Okay. The debtor, which was an asset or is an asset, will then be credited because the debtor decreases. Okay, the asset decreases. Since the debtor's account is credited, the debtor's control account will also decrease. Okay, so the specific debtor's account will become less, and therefore the debtor's control account in the debtor's or in the general ledger will also decrease, and that's the triple entry principle. Okay, so we're going to look at that now. Example on the 10th of May. H. Shady, balance in the debtor's ledger of PEF stores was 320. The account is long overdue. Okay, PEF decided to write off the debt. Okay, so let's look at everything we talked about now and in an example here. Okay, so we see that the 320 will be debited because this bad debts is a expense. Okay, it's expenses and will therefore be debited. H. Shady is a specific debtor and his account becomes less, and it's being written in the debtor's ledger number 4, so he gets credited. Now the triple entry is to write it in the specific debtor's account and then take it to the debtor's control account, because this debtor is one of all the debtors. So the debtor's control account will be debited, and then the last thing that we do in a general journal entry is to write a specific something that happened. So the account is written off as bad debt, just explaining what you are doing. You add everything together and there's nothing under creditor's control. Notes, first line indicates that the account is debited, the bad debts. Second line indicates the account credited. This amount is also credited to the debtors control account. That's a triple entry. Okay, and then there's the narration, and then we draw a line to show that the entry has finished. Okay, so now remember we're seeing here the debtors control is 320, and what was the reason? It was bad debts. So debtors control becomes less, the asset becomes more on the debit side and less on the credit side. The debtors in general becomes less, and we write, I would prefer you writing bad debts. Okay, so if debtors control is credited, then something else must be debited. Okay, so there we go, bad debts on page 170 in your books. Bad debts is a nominal account, the expense account. It makes the owner's equity less, and that's why we write it on the left hand side. So the other account is debtors control, and we write general journal. And then lastly, the debtors ledger, HJDL number 4. Okay, so we had opening balance of 320, he owed 320, and now we write bad debts in the general journal, and now we credit it because assets become less on the credit side and more on the debit side. Okay, so this is a debtors ledger, so it decreases your debts or the person that needs to pay, and now he owes us nothing. Okay, sometimes the debtor that is whose account was written off reappears. In this case, a new account is opened. So now he pays, and now it becomes an income again. Bad debts recovered is the account called. This entry is called in the CRJ. Okay, so bank is debited, we're receiving money, bank increases, and bad debts recovered is an income and is credited because it increases the owner's equity. Okay, the concept of materiality states that the amount is not subtracted from bad debts, but instead it's a separate income account. So we show it, we don't offset the two bad debts and bad debts recovered with each other. We only we give a separate line item in your income statement to show that it's material or important. Okay, so, alright, so that is basically what we did here. However, overall effect on the income will reduce the expense. So if you offset, if you debit one account bad debts and credit bad debts recovered, then automatically there will be an offset. But you must write it down as two separate accounts. That's the only thing that's being said here. Okay, that's all for bad debts.